Hello and welcome to our webinar, everyone. This is the Investor's Guide to Impact, a science-based view. I'm here with Samuel Baumgartner, one of our gurus of impact investing at Responsibility, and also with Florian Heeb, a researcher at the Center for Sustainable Finance and Private Wealth at the University of Zurich. There he is. A little bit about Responsibility. We are a sustainable investment house that specializes in impact investing. And for all of you who might be at the COP26 next week, the UN Climate Conference, we will be there. We will be presenting on how to invest in sustainable food systems. So if you're going to be there, let us know. Maybe we'll catch up at the COP26. All right. Please type your questions into the chat function on the side at any time during the webinar, and then we will get to them at the end. So handing over to you, Samuel and Florian now, and I will be back at the end with everyone's questions.
Thank you very much, Stacey, for the introduction. A very warm welcome from my side also to the audience. I hear we have quite a turnout. About 50 countries represented, amongst others Peru, Nigeria, Bangladesh, and many more. It's obviously great to see that there's such a strong interest across the globe in this topic. Also, a very warm welcome to you, Florian. It's a pleasure to have you joining this webinar.
Thanks a lot.
Definitely great to have you here and to be able to pick your brain a bit in the next 20 or 30 minutes. Before we get started, sustainable investing and impact investing has been in the media and all over the board, but we would also like to get to know you, the audience, a little bit better. And as a first question we would like to place to you is if you believe that what the banks claim to be a strategy is sustainable or not. We would like to get your input. And in the meanwhile, Florian, you've been working, or you started your career as an environmental scientist, at ETH. You've worked for different organizations. How did you end up looking at finance?
So, Samuel, thanks first of all for having me here and for the introduction. So yes, I mean, as you mentioned, my background is not in finance. So I'm an environmental scientist by training. I studied at ETH. Then I worked quite a while in the climate space. I worked for My Climate, a Swiss NGO, then later for South Pole, which is now the market leader in carb offsetting. There I worked in the management team for quite a while. And especially during my time at South Pole, I more and more got in touch with the financial industry. At that time, we're developing first data services, first ESG data services for funds. And in some way, I noticed that there seems to be quite a small overlap between sustainability, business industry, and the financial industry. At least at that time, it was the case. And one particular topic I noticed is that in the world of carbon offsetting, everything you talk about is impact and additionality. So do your projects, do they really create the impact that you later want to sell in terms of tons of CO2? And I noticed that this notion of additionality and impact didn't really reach the financial industry yet. So at one point I decided to go back to academia, to a PhD, and that's now the topic of my research. So how can investors create real world change?
Interesting, certainly interesting overlap, bringing in the scientific part, I guess also the strong dependency on data and data analysis to actually make sure that what we're trying to do makes sense. And I believe in the meantime, we've gotten the results from the poll. There's quite a few people who believe sometimes it is sustainable, sometimes not. There's also, as we can see, almost 50% of the participants don't believe their banks. And I guess this also feeds into a bit of the news that we've been seeing more regularly of the whole greenwashing topic. What's your take on the outcome? Are you surprised to see this result, Florian?
I'm not really surprised. No, I mean, especially not after like the debate we had like during the last year on greenwashing. So, I mean, as reflected now in this poll, I mean, on one hand, we need to say sustainable investing has been growing incredibly strongly. I mean, we have seen tremendous growth rates over the last few years. There's a global estimate that we have now something like $35 trillion of sustainable investments. Currently, that amounts on currently some inflows into sustainable assets of something like $4 trillion. So huge numbers. But at the same time, we had an intense discussion on, yeah, now we have all this growth. So does this translate into real world change? And there is lately there has been the so-called ESG whistleblowers like Tarek Fancy and Desiree Fixler coming from the inside, the very heart of the sustainable finance industry, from big asset managers saying, it doesn't have the impact we promise. It's more as a dangerous placebo. It doesn't deliver the change that the investors expect. So we need to be very careful. So it's a huge topic, greenwashing, certainly. But I think it's also important to really, it's a tricky discussion, because the question is, what do you expect from sustainable investing products? And there we need to be very specific, I think, to have a good discussion on greenwashing.
Definitely, and I think that's what we see very often, is how do you go about to define it. But before we take a closer look at this, I would like to take a step back and also look at at sustainable investing from the perspective of why does it make sense in the first place. I mean, we know the environmental component, we know the social component, but as an investor, why should this be one of your key components that you look at when you do an investing from a basic investments perspective?
No, I think that's a very good question. I think this is the exact question that is not asked often enough in the current debate we have on sustainable finance, and whether it is, greenwashing, or it really makes a change. I mean, we need to be clear about what's the objectives of investors. What do they expect from sustainable finance products, and how do certain products deliver live up to the expectations or not? And if we talk a lot to investors, we do surveys, and we see basically three different key motivations investors have why they choose sustainable investing products. So performance, values, and impact. So performance is all about this narrative of, for example, with ESG integration, if you take a broader set of material ESG risks, in addition to the normal financial numbers you take into consideration, into your investment decisions, you will, on average, make better decisions. And especially, you will be able to reduce the risk of your portfolio, and thus create better risk-adjusted returns. Or, for example, also performance argument. We see a lot of thematic funds right now. So some people believe that, for example, renewable energy is kind of the rise, and how strongly renewable energy companies will raise is currently underestimated. So it may be good to have a certain allocation to the renewable sector, because some investors expect that to perform very well with increasing climate action, for example. But both kind of ESG integration and over allocation into impactful companies because of growth expectation, that's both performance arguments. So investors expect to generate outperformance by taking sustainability factors into consideration. And the second, and I think for this, I mean, the ESG industry has done a good job to provide products that cater to performance, expectations. The second is values, and I think that's where sustainable investing initially comes from. So many investors have personal values and belief that they want to have reflected in their portfolio. So sustainable investing actually started with the Quakers excluding slavery. So by divesting from all companies that are associated with slavery in the US. That was a purely value-driven argument. And that's also where responsible investing has been putting a strong focus for a long time. There's a lot of products screening out so-called sin stocks like tobacco, alcohol, now weapons, now increasingly also, for example, coal mining and other similar climate-related issues. But here, the thing is not about impact. So it's rather about many people just simply do not want to profit from coal mining, because I think that's not morally sound to profit from a business that's kind of fundamentally damaging our planet. But just because you exclude cigarettes and tobacco, it doesn't mean that you necessarily want to make cigarettes go away with these tools. So it's not about impact. And again, here I think that the sustainable investing industry has been very, very sophisticated in delivering different screens. More and more, I see products that cater to more specific sets of values of investors. But we have to keep in mind, values is not impact. And that's the third motivation we see. And we increasingly see that this is the main motivations, or the most prominent motivation of many investors. So really to make a change with investments. So not just reflecting values, not just optimizing performance, but really making a contribution towards solving some of the world's most pressing challenges. And here, I think that the financial industry, especially the ESG and sustainable finance, has to do a lot of work, because often, there is kind of vague claims. There is some implication the product is green, that it creates good, but it's really not clearly declared how a certain product generates impact, how much impact it creates, what are the assumptions that are taken in its impact theory of change, and so on. But I think in order to have fair discussion on greenwashing, we really need to differentiate. I mean, it's not fair saying that a typical ESG fund is greenwashing because the fund doesn't have a real world impact if the fund's objective from the start was to generate better performance. Likewise, it's not fair saying that a public equity fund focusing on engaging with dirty companies to make them better is greenwashing because it contains coal companies. That was not the objective, to reflect values. The objective was to create impact with engagement. I think it's very important to keep these things in mind.
And I think that's a valid point to first of all question what is actually the target of the investment, and how does it align with the value of the investor. And that brings me to my next point, or next question that I would like to place is how do you differentiate between the different types of impact when looking at, for example, investors' impact and corporate impact? I mean, we know that if I buy a green stock on the stock market, I don't really actively contribute to reducing even a single gram of CO2. Could you go a bit into more depth, also remembering that, and you see that in the handout section, there is the impact guide that you've recently published. Pick up this a bit and comparing investors' impact and corporate impact, and how you can actually have an impact as an investor in that ambience.
Yeah, certainly, happy to do so. So that's basically our research topic we have been looking at over the last 5 years. So 5 years ago, we started research agenda of the Center for Sustainable Finance and Private Wealth at the University of Zurich, where I'm currently working. It was a new center, and we were looking at the entire space of sustainable finance research, and we saw that there's literally 2,000 studies summarized in a meta review by colleagues on does it pay to be green, but almost nothing on the impact of sustainable finance and on how investors can have impact. That's why we started a large research project. We published some academic papers on it, but we have tried to summarize it in a more accessible visual way in the Investor's Guide to Impact that you find in the download section. And I'm happy to provide some of the key insights of this guide and of our research. I would like to maybe start with 3 core insights. First of all, what is impact to start with? So I think it's exponentially growing how many people use the word impact and how many marketing brochures use impact, but we talk way too little about what impact actually is. And there's clear definitions coming from development space and so on. So impact is the the change you cause with your activity. So you do something and something changes because of you. So this causality it sounds trivial, but this causality is rather tricky. So you always need to check what would have happened without my activity. And the impact is only the change you observe beyond what would have happened without your activity. So in carbon work, carbon credits, but also in impact investing, people call this additionality. Economists like the term often to use counterfactual impact. But it's always the idea of you need to check what's the baseline, what would have happened anyhow, what happened because of me. And I think in many areas of our daily lives, that's relatively straightforward. Let's take the example, I have a fossil car and I want to replace it by electric car. So here my impact is relatively clear. I mean, I used fossil fuels, I burned fossil fuels, I emitted CO2. Afterwards, I have an electric motor which doesn't emit CO2. So I had a direct causal impact. So the baseline is fossil car. The change I observed is emitting less CO2. Obviously, you have all this question about life cycle and so on, but I think that's not the point I want to make. It's that in many areas of your life, you can have it's relatively straightforward to see connection between your action and what happens. It's not so easy if we look at investing, because with investments, everything you do is necessarily moderated by complex financial markets before it arrives in the real world. And here, that's our second insight. It really helps to differentiate between what Samuel has already mentioned, between company impact and investor impact. So company impact is the change companies cause in the real world. Staying with electric cars, maybe let's take Tesla as a maybe also a bit controversial example nowadays. But Tesla has a certain impact on the real world. So they produce electric cars. These electric cars replace again fossil fuel-driven cars. So you have a positive impact, but of course, to measure the impact of Tesla, you need to consider the life cycle emissions of all these batteries and so on. They may have certain social impacts that may not align so well with their environmental impacts, but so on. But all these questions all questions about company impacts are about how does a certain company affect real world. The important realization is your impact as an investor is not just the sum of all companies' impacts, of the impact of the companies you own. It's the change you cause in company impact. And that's what we define as investor impact. So the contribution you make to changing these companies. So we define investor impact as the change in company impact caused by your investments and by your investor activities. And I think that this double kind of impact pathway is really crucial to understand and to keep in mind when discussing the impact of investing products. And often I feel 99% of the discussion is focused on company impact. So we see increasingly complex and elaborated measures to have good numbers on company impact. There's still a lot of things to do there, but I see a lot of progress. I see almost no progress or very little progress on the investor impact side. So if you have a product, of course, you can measure company impact and how good or how bad companies in your portfolio do. But if you don't have a good measure on whether your investment actually makes a change in these companies, what's the point of it? So I think it's way more crucial to focus on the first part. And that leads me to our third insight. So we did quite an extensive study on the different mechanisms how investors can influence companies. And we see two fundamentally different ways how investors can affect companies. The first mechanism is growing green companies. So by consciously allocating capital to companies that need capital to grow, to green and impactful companies that need capital to grow, and enabling them to do growth that they couldn't otherwise without your money. And there's plenty of evidence that this works quite well that this can be very effective for small companies, for companies in immature financial markets, developing country, emerging markets, very young companies, and so on. But we did not find any evidence that this works for very large established companies on American or European stock markets. Let's take Tesla again. I mean, what difference does it make if you buy a Tesla share or not? It will not, at least that's what we see in our research so far. It will not really make Tesla grow any faster and slower if you buy or sell Tesla shares. Tesla's growth right now is purely driven by demand. So whether people buy their cars and not by tiny changes in their share prices, if it's really possible to move their share prices by buying and selling share prices in the first instance. So that's the first kind of pathway, taking your money, putting it somewhere to work where it really causes growth. It has this caveat that it doesn't really work in efficient financial markets, because these markets are efficient and demand doesn't play demand from investors doesn't really play a strong role. The second channel is promoting improvement, and that's fundamentally different. So this is about going into brown companies and making them greener. So there's different ways how investors can do so. One very prominent way is voting and engagement. So making use of your power as investment, so the voting rights, or also access you may have to management, convincing companies to adopt better environmental or social practices. So let them do whatever they do, but in a little bit greener way. And that's the caveat here is that's limited to incremental change. So we have seen quite some interesting cases where investors were able, for example, with Exxon, to change the board of an entire oil company. But do not expect that Exxon will produce less oil because of that. They will maybe adjust over time their investment into renewables, which is laudable and really important to tackle climate change. But as long as oil is digging out or drilling out oil is profitable, the company will do it, or they will outsource it to some other companies. But this change pathway can really work well for large established companies, but it's limited to incremental change. So step by step, making companies somewhat greener.
Okay, so basically, you really need to be aware of what your money does and where it goes, and also be aware of that if you just play around basically on the public listed capital markets, you're unlikely to have a direct investor's impact with the money that you're placing. Now, if you're an investor, you've now decided that this sustainable investing is important for you, that you do want to have an impact of based on your values, for example. How would you go to approach this? So how would you go about to set the right filters, being maybe aware of exclusion, inclusion lists, and so on? Did you have any tips for investors to go to tackle these issues?
Certainly. I mean, first of all, it really depends on what type of investors you are. If you're, a large pension fund, or a sovereign wealth fund with tons of money, I mean, you have another access. You have way more power, to go to companies and try to change them. And you also have access to these exact products that offer you the chance to boost green growth, to invest in small companies in emerging market. The problem is with, I think, these investments that I would call traditional impact investments, is that they're often not available to smaller investors, to retail investors. So I often hear the question, I mean, I'm a retail investor. I'm not a big investor. I still want to have impact. How should I go about this? And I think there's some interesting aspects. First of all, I mean, I talked about shareholder engagement and voting, and many people feel, yeah, I'm just a small, investor. I owe maybe a tiny fraction of some large company, so it doesn't really play a role. But aggregation is a huge, topic here. So you can invest into funds that offer to pool all the voting rights and all the shareholder voices they have into one big fund, and then approach companies. There's some really cool products emerging now in the market. I mentioned the Exxon case, where a small hedge fund managed to exchange a huge company's board substantially. They now launched the ETF on the American stock market, S&P 500, where they do the exact same things for many retail investors. They pool their voices, they pool their shares, and then they approach large companies and push them to become greener. So that's something to keep an eye open. And just also, if you just have your bank, where you go, always ask your asset manager, do you vote my shares in accordance with my targets? And it's a really easy first step to go about this. I mean, and then there are some products that go more into more inefficient markets, to emerging markets, that are available to retail customers. I know Responsibility has been a pioneer here in Switzerland, but there's also other solutions where you can maybe take smaller portions of your money and go into some riskier things. What I also usually see is that people underestimate is, I mean, sometimes I have talks and people say, but I'm not an investor, why should I care? Most of us, almost everybody, is an investor, at least through his and her pension fund. And again, here you have a huge investor that is able to invest into risky companies in emerging markets, or is able to buy a relatively expensive engagement service, or directly engage with large companies, because these pension funds, they amass a lot of capital, and especially if they then connect together, they have sufficient power to really change what companies are doing. And so, but I feel that many pension funds are not really taking into account what their beneficiaries want in terms of values. Whether they, so I think pushing one's own pension fund, saying, how do you what do you do with my money in order to make the world a livable place in the time when I want my money back, or even for my children that may live in longer time spans, that I think they can also be a quite powerful tool.
Definitely. So definitely one of the first steps being to start asking questions to make sure that you can get into the direction that that you want your money to go. And with that, we would like to know from the audience of how high they would rate their sustainability level of their portfolio. And I know we're almost running out of time, but maybe Florian, in 2 minutes or so, you could give us a quick insight while you were looking at the different research topics that you've been working on recently. How has your portfolio changed over time while we're waiting for the answers to come in?
I have to say I was rather frustrated in the beginning because I thought, I mean, why should I invest sustainable at all if we see that most products do not have an impact? But now, I mean, as I mentioned, I mean, going into more this engagement path, especially for smaller retail investors like me, that could be really interesting. Yeah, and just pushing large investors, just asking critical questions. If you have a meeting with your bank advisor that wants to sell you a new green product, just being a bit critical, asking, I mean, that looks like a sustainable product. How does it really create change? How does it help me to create impact, real world impact with my money? I think that already helps. Just creating more scrutiny around impact, creating a demand for products that do not just feel green, because I see that as a problem that many investors, we also show that in our research, many investors are just happy if they receive a product that looks green without further drilling down whether that actually causes impact. Of course, there's other, as I mentioned, motivation why you may invest sustainable. But if you want to have impact, then just asking critical questions is a really important first step.
And I think the poll to some extent also reflects that a bit, that we see almost a quarter of the respondents say that they're not really sure how sustainable their portfolio is at that level. I think my suggestion to them is, if this is something that they value, is go and have this chat with your bank advisor to see where this is actually standing. With this, I would like to wrap up with the key takeaways that we've had. We've had an understanding of why sustainability is important to not only make a better world, but also to safeguard your assets. We saw the difference between corporate impact and investors' impact and how to drive the individual ones. And we also saw what it means to be investing in a green or in a brown company and what the results can be. And with that, I would like to hand over to you, Stacey, for the Q&A.
Yes, we'll dive right in. All right, Florian, the EuroSIF report highlights 3 ways to deliver impact. Can you explain/defend the third, sending market signals through capital allocation? I thought your research had called this link very weak.
Yeah, I think that's the entire channel about signaling. So I think I have to say on this question, we do not see this. Let's repeat it. There's 2 ways you can send signals. I mean, is it really a growth signal, preparing better growth conditions for green companies to grow faster, large ones? I would be very critical about that. But creating small stock price signals for companies to improve. For example, if everybody agrees on a final ESG rating, and if all companies know what they need to do to improve in this rating, this can, just this market signal created by the capital allocation of all investors can create companies to improve. But again, that's not this green growth channel. That's the improving brown companies towards green channel. And that's an ongoing area of research where we're still, doing a lot of work on. There's a lot of theoretical models that say if investors have certain, certain preferences, a lot of investors have certain preferences of how companies go about their businesses. So not, excluding entire industries, but it's kind of conduct-based green. This should provide the stock price incentives for companies to do this if it's not too costly to do it. And that's, we're currently doing some empirical research to work with kind of to falsify or kind of to confirm the findings from these theoretical models and to show better how strong this effect is and under which conditions we can really work on.
All right, I'll give you a little break, Florian. This next question is for you, Samuel. As an asset manager, how do you deal with the failure of well-intentioned product solutions?
Well, that's a good question. I mean, I think the question is like what we've mentioned during the webinar. In the end, it's also up to the investor to ask the right questions and to get an idea. We've seen when we try to define sustainable investing in the first place that this is not a black and white question. It depends. It depends how you define this. So I think in that way you can also circle back a bit and then and ask under which circumstances did this project fail? Did it fail in addressing a specific topic, or did it fail in just achieving results, for example? And I think there it's very much a question of alignment with the for example individual values or with the individual targets set. I think we as an asset manager, we have very clear defined topics that we focus on and that we address when we launch our product line, and obviously try to avoid to the best of our abilities to avoid any such failures as indicated in the question.
Great. And we'll take this final question, which is a big one also. What is the biggest challenge of sustainable investing? Is it greenwashing? How would you define it? Is it ignorance from the investor and who's not perhaps very well informed?
You know, I would say the greatest challenge of sustainable investing right now is connecting this enormous demand from investors to make a contribution towards a better world with real world impact. So, because most investors do not have a lot of time and headspace to wrap their head around how can I really make a change. At the same time, they want to do good. This creates a lot of incentives for asset managers to produce green products, but not necessarily an incentive to produce really effective products in terms of creating real world impact. And so the system may not be as effective as it could right now. And there's a lot of challenges. We need to educate investors on what actually causes impact. We need measures of investor impact. As I mentioned, we have a lot of measures of company impact, but without a proper measure of investor impact, we cannot really connect demand for change with real life change, because we do not have the tools available to easily kind of in a clear and easily understandable manner to judge and assess products, which is what investors then need to make well-informed decisions how they can connect their investments to what they actually want if they want to change the world for better.
All right, great. Well, we're over time now, so thank you so much, Florian. Thank you, Samuel. Follow us on LinkedIn for future webinars, and wishing everyone a wonderful rest of your day.
Thank you very much.
Thanks,
Bye-bye.
everybody. Bye.
Bye.